We have to make an educated guess on what the market's going to do. I remember the first property we bought where the interest rate was below 5%. It was at 4.85. And we're, yes, we got to look at how great we are, get this low interest rate. Well, rates kept going down and down and down and down. And we had a fixed interest rate. This is one of the ways that we mitigate risk also. We used a fixed interest rate, so our payment stayed constant. If we would have had an adjustable, our rate would have been lower to begin with, and it would have went down over time. Then the risk is when we sold that prop, we had a $22 million loan, and it's got what they call defeasance. It's a prepayment penalty, for lack of a better phrase. They have to replace that debt by buying bonds. They're paying lower for those bonds, which means that I have a $22 million loan. In this particular case, it cost me $27 million to pay it off. Now, that's a $5 million lost paycheck right there. However, I took that risk because if interest rates would have went up, that would have been done last year, the fixed rate loan, I still would have been safe. Interest rates were lower, I would have been hurt a lot by that. Even though we had to pay the higher defeasance amount, we had to pay $27 million on a $22 million loan. The biggest part of that gain was because the market went up. We're not playing the market, but because the market did go up, we did have that big prepayment penalty. We could absorb that without having the risk.